Good morning, traders. Welcome to ECB Day, my favourite day of the month, when we get to listen to Lagarde waffling on and on and on and on and on. If you need a cure for insomnia, today's the day to get it. Got your coffee on, Kate?
Morning, Ryan. Morning, everybody. I'm impatiently waiting for the climate question of the press. That signals the end of it. So we are just waiting for that one and to get it all over with.
Yeah, and I'm not got much hope for this one, I have to say, in terms of excitement. But you never know. You never know. Markets like to surprise us when we least expect it, as we know. Right, let's get cracking. PBOC, after their little sources drop yesterday about maybe letting the one weaken, they kept their fixed rate at the 718s. So they've not shifted that yet, or allowed it to shift. The Ministry of Commerce said China is willing to increase talks with the US on trade. Usual waffle, they're always willing to increase talks. Whether that happens or not is another thing. Over in Japan, Reuters have been busy with the old surveys this week. They've done a corporate survey, and the biggest worries for Japanese companies are tariff hikes, US tariff hikes, and US-China relations. Nearly 75% of firms expect Trump's next term to have a negative impact on their business environment. 50% of companies expect higher earnings in the next financial year. And about 60% expect the dollar to trade between 140 and 150 yen in 2025. I wanted to ask you about that in particular, Kay. How them looking at yen levels, how do they factor that into their businesses in terms of hedging and the like?
Well, I mean, this is a relatively, well, historically seen a relatively wide range, because usually they go a bit tighter, but I think seeing the volatility, they want to keep it in a relatively wide range. Well, I mean, it is going to have an effect if you budget a certain FX rate. It has an effect of obviously on your profits versus budget, especially for the big exporters and who are the car makers, the heavy machinery makers, just to name those two sectors, and the big importers, who are mostly energy and raw materials. So it does have an effect that if you go for the exporters, for instance, imagine that we are staying higher in the yen, in the dollar yen, that's going to have a beneficial impact on the yen P&L. And vice versa, if dollar yen goes lower, it's better for the importers, obviously. They may be tempted if you get outside of the range. That's especially, but because we have to look at everything, swaps included, right? Because for exporters, for instance, if they sell dollar yen at the beginning of the year, if we are at 155, but their budget rate is put, and you have to look at it in fiscal year in Japan, right? So you're talking about April to end of March. But in theory, if you sell at the start of the fiscal year, you're going to pay away carry, of course, because you're selling your foreign currencies outright, and you pay away the swap, right? So they will be looking at rates. The higher we go, the more they get interested to sell some dollar yen, and the importers are hoping for the opposite. The lower it goes, the better they can buy, and they can actually anticipate a little bit, because if they buy their foreign currencies earlier, they're going to get the carry for it. So that's about how it works, the budget rates, and how importers versus exporters can hedge their stuff. But it's a little more complicated than just that, because usually Japanese corporates, they also put some form of options in place where they have for instance, the possibility to sell dollar yen higher, providing that we are not breaking down below 130 or so. So it's a bit more complicated, but in big terms, that's about it. How they will hedge. So exporters are usually tempted to wait a little bit longer than importers due to the swaps as well.
Yeah, so just quickly looking on the other side as well, you know, the old big whales and the pension companies and whatever, they've been going unhedged on the FX side the last couple of years, I think it is. Will this volatility be affecting them? Might they think of hedging a bit more? I mean, they've obviously, if they've invested in the US then and making money, then they've done well to stay unhedged because obviously the currency's gone their way. But would the volatility that we're seeing these days maybe get them thinking about hedging a bit more?
That's a good question. I haven't seen the whales budget rates. Obviously, the insurers will be part of will be doing that, and let's just think about those instead of the investment funds. Because the investment funds is it's a bit of a different animal because they have like investment ratios like local JGBs versus external bonds. Then they have like equities and so on and so forth. But I think if you look at the insurance companies, for instance, as we have seen, Nippon Life is trying to invest in the US. So obviously, the dollar yen will have an impact on their revenues. So if you invest in the US, you're actually hoping for the dollar yen to creep up at the same time. Although they are usually looking at just returns, and then the FX comes in a second leg.
Yeah. Yeah, cool. Okay, then again, that's something we'll probably have to keep an eye on into next year as we creep towards the financial year in Japan again and see what all those big whales want to do with stuff.
Well, I mean, if you take the example, for instance, dollar yen has really ramped higher over the past few years, and Japanese exporters have posted record profits. GPIF was also had like very good profits because equity markets mostly went up in and outside of Japan. And so those are the things, if you look for comparisons, those are the things that they usually will reflect, you know. So for the companies like exporters and importers, the exchange rate is probably more important, I would argue. Although amounts at the whales are gigantic, of course, but I'm looking at percentage of returns. The manufacturers, and the importers of raw materials and energy, those things will impact their bottom line directly if FX moves.
Yeah, thanks, mate. Thank you very much. Reuters felt a bit left out yesterday after Bloomberg went with a BOJ sources piece. So they came out with their own one, pretty much a rehash along the same lines of what we heard, that apparently the BOJ is going to be leaning towards keeping rates on hold next week. Not quite the same reaction in the end that we got from Bloomberg story when you pretty much drop the same line. Markets are going to start ignoring it, but we should perhaps start thinking about further sources drops leading up to the meeting next week, but only if they are different. If they are pushing more for a hike, then that's going to change the market. But the more times you get a sources piece saying the same thing, the less interest the market has in it. But that's where we're leaning at the moment. The market potentially leaning on the side that maybe they won't hike next week, which obviously makes the bigger risk that they do. Right, coming over to some data and a bit of a surprise for Australia. Unemployment, a pretty decent report. The employment change saw 35.6 thousand jobs added, beat expectations of 26k. The employment change there as well, pretty much all going into full time. That's all 52.6 gain, offset obviously by what went into the part-time numbers. We saw the unemployment rate dropping to 3.9%, was expected to rise to 4.2%. A bit in part of that was down to the participation rate dropping back, but that small 1 pip pullback doesn't equate to 2 pips down in unemployment rate. So that unemployment rate is a decent looking number. So it's going to be good news for the RBA in terms of jobs market, and potentially pushes out further potential rate cuts. But they are looking at inflation mostly for that. So good news there. We've seen a bounce in the Aussie. We'll talk about that shortly. But as far as that side of things goes, all tickety-boo, unless it all goes backwards next month. We shall see. The S&P, they decided to pull a little rabbit out the hat, going a 50 instead of a 25 as expected. Rates now at 0.5%. As usual, they're prepared to intervene in FX if needed, and will continue to adjust monetary policy if necessary. They cut their 2024 inflation forecast by a pip to 1.1%. Not that it matters now. We're a couple of weeks away from ending the year. More significantly, 2025 inflation was halved from 0.6% to 0.3%. 2026, though, was raised by a point to 0.8%. New man Schlegel, first meeting as governor, says that without today's cut, the inflation forecast would have been even lower. And inflation since the last rates decision has been lower than expected. He says that rate cuts continue to be the main instrument if monetary policy needs to be eased further, and we still have ammunition left on rates. We already said further rate cuts might be needed. In an age that we can target a weakening of inflation below 0 to 2% target range, as long as it is temporary. It says it's possible to have sub-zero inflation in some months. Then he did a bit of rowing back, because his prior comments a few weeks ago brought up the subject of negative rates. Now they're still in the toolbox. He said the SNB does not like negative interest rates, and the likelihood of NERP has become smaller. He says if needed, we will adjust rates at the March meeting. Okay, bit of a surprise, not surprise for the rate move, and a bit of dialing back.
Was a coin toss. I'm down two to one for now on the central banks, because I thought everybody was going to do a 25, but Bank of Canada and SMB went for the bigger ones. Yeah, it's 90% dovish, 10% I don't like to go to negative interest rates. And we saw the move on the Swiss when they cut by 50, and Schlegel coming out, or the statement coming out, relatively dovish. And then now we have already given back, or the Swiss has taken back, let's put it that way, half of it. Yeah, what can I say? I mean, it's about the same thing as when you look at the decisions or the big data that we have seen of late. You do a big move, and then the move is not really sustainable, or not really sustained, unless we get second waves, of course. But they are dovish, right? They are dovish, and it's maybe the reason and the excuse at least was halving that inflation outlook for next year, and we know they're only meeting like once every quarter, so they need to give themselves time to let those inflation data come out. But yeah, Schlegel is a bit of a Jordan beast now. Let's give the US corporates what they want, and then we will see what we need to do to make it happen. The market is another thing. The market doesn't seem like they really want to be short Swiss for a long time, or at least those moves are not very sustainable. So sorry, I'm not really sure what to make or bake from the Swiss franc into the year end. I must say, And again, I'm repeating this every day, I know, but I mean, that move end of last year is still very much present in not only my mind, I think, but in a lot of people's minds. So we cannot rule out anything in the Swiss franc for the next couple of weeks.
Yeah, and yeah, it does seem like he's taken a bit of a leaf out of Jordan's book into always keep the market
Oh,
guessing,
definitely, yeah,
and
definitely.
not let it get comfortable with its own expectations. So, yeah, Jordan Mark II for the moment. We'll see if that continues. Back to Reuters and another poll, this time on the UK. The majority of economists in this one see an insignificant effect on the UK economy from Trump's proposed tariffs. So not likely to hit the UK too hard, which is something we've been mentioning on the show here. On the BOE itself, they expect the bank to cut by 100 basis points in 2025. That's been roughly the standard expectation for next year. And they say likely by 25 pips each quarter. They say the bank will hold steady next week at 4.75%, say all of the 71 economists polled. ECB, they've been, the market has been ramping up slightly. Their rate cut bets are now say 158 pips of cuts through 2025. Part of this recent move, a lot of market getting a bit more dovish over the ECB, how quickly they're going to be cutting and getting to a potential neutral rate. Back to the data, US CPI came in as expected. Headline CPI at 2.7%, the core unchanged 3.3%. So nothing really to get our teeth stuck into there. If you want to pick the bones out of it, it's inflation remaining sticky. It has gone up for the second month on the trot. The core number continues to go sideways, roughly 3.2 to 3.5 range. So sticky, sticky, sticky. Average hourly earnings year on year came in at 1.3%, down from 1.4 prior. Average weekly earnings year on year came in at 1% versus 1.4% prior, so slight softening there. Looking at all the components and 25th decimal places and all that crap, services inflation as a whole year on year did pull back to 4.6%, down 2 points from the 4.8 last month. The shelter component of that services also dropped 2 pips to 4.7% year on year. So that's been coming down, although the month on month numbers were still positive, but the year on year numbers moving in the right direction, albeit still a bit slow. Then you look at the much talked about super core number. That went up on the month, 3.42% from 3.14, but it dropped a bit on the year, 4.25 from 4.37. So basically all that data from the US pretty much baked in a 25 next week from the Fed, and still keeps the potential for pause language to come in as well, and maybe to hint that they might be a bit more cautious next week and going into 2025. Kay, has that sucked the life out of next week's Fed?
It could. It could. Yeah, people looking already at looking also at the PPI today, but I think if it doesn't come out too far from expectations, that will be a non-event. It could have completely reduced the importance of the Fed meeting, although it's towards the end of the year, so the market will probably move quite a bit on the back of it. But yeah, I mean, this is not pushing the Fed to be dovish, I would say, based on inflation and on the rest. So we could be in for a bit of a hawkish cut. I still think they will cut, but it could be a hawkish cut.
Yeah. I think if Powell could have picked perfect numbers, it would probably be these numbers coming in line. Anything hotter like that, hotter than we got yesterday, and he would have had to answer some questions.
He's
got,
yeah, he's basically got what he wanted. This virtually the whole second part of the year. Huh?
Yeah,
Inflation, okay, maybe inflation a bit stickier than they would have liked, but the rest is doing pretty good. Look at the US asset markets are doing pretty well, equities, and so the only thing perhaps is that he would have liked rates to be just that lower, but it's mostly in line with a near perfect scenario. Okay, CPI may be a few ticks too high, but it's yeah, it's a good scenario for him.
yeah, exactly. And then we move on to the Bank of Canada, who decided to go a 50 as well. Another one that was a bit of a coin toss going into the meeting. Now, it was, as we did expect, if they had gone a 50, that they then went into a potential pause, and that they did. They removed language from the statement when they said it would be reasonable to expect further cuts if the economy evolves in line with forecasts. That was taken out. Now they need to evaluate the need for further cuts, one decision at a time. Macklem said the Governing Council discussed 25 and 50 pip cuts today, but there were some mixed signals in the data. The unemployment rate has gone up, but we have not seen widespread job losses typically seen in a recession. They don't expect to see a recession either. He said they will consider further rate cuts going forward in a more gradual approach. So they've yanked rates all the way down, 175 basis points since the summer. They're now at 3.25%, and it's looking like they're going to be in a pause. Not that the market sees that. The Canadian swaps market sees a 70% chance of another cut in January. That seems quite high considering what we got from them yesterday. Are they on pause, or are they going to cut still, Kay?
Well, McLean still wanted to be to leave the door kind of open, right? It's ajar for doing more, but it's not like wide open. Yeah, I thought they would do 25, but they decided to do 50 to bring it to a level where they perhaps can pause much easier pause than when they had if they would have done 25 and forced by events once Trump takes the seat to do more. But yeah, they already front loaded it. So I don't know what to think about it, but I think they could be on a prolonged pause if the Fed pauses as well now. Perhaps they will look more at what the Fed is doing. Now they have widened that gap significantly.
Yeah, very much so enough. It's funny because the BOC, they can tend to lead what other central banks are doing. They've still got plenty still cutting and looking
Kiwi
to
and
cut.
Kiwi
But
and Morgan
yeah,
Stanley, Bank of Canada.
yeah, they can be a bit of a leader. Who'd have thought it? When they can't even get their data up to date, they still run 2 months behind everyone else. But they can lead on the old central bank front. Right, OPEC. Now, beginning in November, the OPEC General Secretary came out saying the world economy is doing well and we are positive on demand, both on the short and long term, and said that the picture is not as negative as some make it sound. Since then, they've slashed their demand forecast twice. The latest being yesterday, they've cut the 2024 oil demand growth forecast again to 1.6 million barrels per day versus their prior forecast of 1.82 million barrels, which was down from a prior to that to 1.93 million barrels. They've also cut 2025 demand growth to 1.45 from 1.54, which was a cut from 1.64. So much for positive signs on the demand picture. All they've done is cut their demand forecasts since then. And obviously, until we see a pickup in manufacturing around the globe, that's the way it's going to stay for now. Over in the US, outgoing man Biden, the snoozer, has hiked tariffs on Chinese solar products, which will kick in the 1st of January. The solar products sector, whatever you want to call it, has been a bone of contention for the US for quite some time. Isn't the first time they've put tariffs on this area, but further they're getting slapped on the 1st of January, probably the first of many when Trump gets on board. Kay, anything else or anything else?
You talk about Biden putting tariffs on China, Trump threatening to put big tariffs on China, and now he's invited Xi to his inauguration. So I just wonder how far he will go against China, you know. And as I was musing in the chat room, Putin may be on G's FaceTime to be live at the inauguration as well. It's all there's going to be a lot of fun and games going forward. I think we should be ready to for anything once the orange man takes the seat.
Yeah, absolutely. And yeah, we should all get geared up for that. It's going to be fun and games, most definitely. Right, where shall we go? Let's have a look at the Aussie, which as mentioned, got a decent bounce. Now, a couple of things I want to show you. We've had a decent bounce. We couldn't quite get up to the old 64.40 area, which really is a big pivot point at the moment. While we're below that, we stay bearish. We're still in this downtrend phase going on, even with this bounce. Now, that's a slightly different picture if you can compare it to something like Aussie Kiwi, which has broken out. And I've been saying this earlier this week, that the hold down here gives it the potential for a bit of a base. So price action wise, we've got one pair that might be turning around, although it's struggled up at one of the old areas, 110.50. But if it can start building a bit of a base, at least above 110.15, 20, 30, a bit of a zone developing here, it could mean more upside. If we get a quick breakdown though, then we're probably going to see a bit more sideways action, maybe following a range 109.40s up to here 110.50s, maybe a bit of sideways action that we've seen plenty of times before. But back to the Aussie dollar anyway. So yeah, the downtrend is still in play. That we couldn't get close to that 64.40 area is a bit of a tell. Decent move on decent data, admittedly, but it doesn't really change anything as far as this one goes versus the US dollar at least. So what we need to see is what happens if we get a test down to some of these levels. We're trying to hold the figure at the moment. That might be significant if we do that. That could give it then a springboard to take it higher. If we fail here, though, then there's every chance we go on to make a new low and keep this trend going. So two slightly different pictures for the Aussie dollar there. I'm sure Kay's got another one in the crosses too. Ali, what you up to today? You're long Looney. Let's have a look at the good old Looney. This one didn't really pull back too far. Obviously, it reacted to the 50, putting back to sort of 41.20-ish, bouncing from there. Didn't even get down to the figure. Doesn't look like this one's done and dusted, Kay. Not too much of a pullback. Do you think we're going to go on and take out that 142?
Well, so much for the buy the rumor, sell the factor. I mean, the market did the move on beforehand, and now we are stabilizing. But if you look at it, we're still stabilizing in a relatively high level. So for this to go lower down, we need to excuse me, we need to get down below 141, I think, and then there may be a chance. Yeah, the red line is what, 140.90? It's a bit small.
Yeah.
Can't see. Yeah, that's the level there, and then you're basically within a 100 points range now, and you break either side. I think that's going to be decisive for the next move. I'm going to be very honest in saying I do not know what to do with the Canadian dollar right now. I just don't know. No.
Yeah. No, I would have liked to maybe a bit of a bigger dip, but it just looked half-hearted, which is a surprise because the Loonie can flip around quite a bit on monetary policy decisions and stuff, but it was relatively sanguine yesterday. So that's a bit of a worry as to whether we can hold below this 142 or whether we're going to bust out of it. So might be worth thinking about maybe a little buy stop above here if we go up there again, because we've knocked on the door a few times since
because
then.
we have to look at the interest rate differentials, which are now pretty wide. Huh?
Yeah,
We've
exactly.
got some real difference now between Canadian and US yields as well.
Yeah, absolutely. If you want to go for that yield, you park it in the dollar for the moment.
Yeah.
Right, euro dollar. Messing around this bloody zone again. Let's go on to, there we go. So we've had another little rally up this morning, hit the 105.30, couldn't get through yet again. Now we're mooching back below 105, still going sideways, still indecisive what this one wants to do and where it wants to go. Unlikely to get any input from the ECB, but it might give us something, at least run us to maybe some of the wider edges of this range that we've got here, 104.50, maybe 104s, maybe even up to 106s. So I think that's about all I'll be looking at for this one. If there's some news that pushes us to those range edges and it's not game changing, then I might look for a little trade. But I'm not really interested in the middle here because it just doesn't know what it wants to do from that. I think for the ECB, they're going to go 25. That's nailed in. Enough ECB members have put that on the line. I do think, though, this is going to be a bit of a wilder meeting for them. Not that we get to know about it until maybe the sources drop later. But I think there's going to be lots of different opinions coming into that. Forecasts, they're out as well, unless they show anything wild, like CPI coming down much more significantly than in the prior forecasts. Then I don't think it's going to change the market's mind of the ECB going forward next year. Kay, can you see any scope for any surprises? Sell it to us.
I wouldn't say so, but the market has the, let's say, weaker euro picture pretty firmly set. Well, I mean, depends against which currency, of course. There's always the other side of the thing. But if you look at the euro dollar, for instance, can't hold that above 105.30.40 already. So that's going to be our first level to watch. I thought that perhaps euro crosses may be a little bit bit this morning because of people being short euros and buying back some, but the moves are extremely limited. We've been been trading in a very tight range everywhere basically. I don't know really euro. The surprise would be that they are not dovish at all. Because if you look at the data, they can't be hawkish, right? I mean, it's virtually impossible. Now, what does the market have to do on the back of it? If nothing else would happen, I would say this is going to be pretty dull meeting. They cut another 25, so the euro is going to be continuing to be a sell on rallies. But more than that, I mean, and I'm really not looking forward to the press conference, by the way.
Yeah, I know. Already some of our chat room bods are deciding they're going to clear off for the presser later. So leave us mugs to sit in front of the screen, and well, at least we've got the old game of whether De Guindos speaks or not. We can play that. We can play that game again to see whether he gets his last words in of 2024. He's probably spoken twice this year, but that's always a game we like to play. Euro sterling, that is staying on the weak side, still waiting to see if we get a move down at least to the 50% retracement down here and maybe the 82 figure. It's still holding below. We haven't really had a test of this break level, 82, 60, 70. So it is still remaining weak. But, you know, we have done this game before, come down here and held it before rocketing all the way back up again. So I don't know if it's going to carry on going, but I'm still in the camp. I'm still short, but I'm still in the camp that I think I will try a little long. I maybe even close the short and flip long rather than do it separately. I'll have to think about that if we get down to that level. What's your thoughts on this one, Kay?
Slippery slope, and I would think that once the ECB is out of the way, unless they, as I said, they are really very, hawkish. I think slippery slope, and we end the year on the weaker rates.
Yeah. Do you think that A2 is going to go, or is that?
Well, that all depends about the flows, Ryan, and I don't know exactly what they are, but according to my own models, which are not models, but just just findings that I have in the market and thoughts. We could be below there. Yeah, I think we could be below there. You know what? I mean, it's enough for Lagarde to come over a bit dovish for to send the euro lower against everything, and as I've been saying already a couple of times, she has been surprisingly undovish, in my eyes at least. I thought that she would flip earlier, and she has been surprisingly undovish. So is she going to give us some sort of a dovish surprise for the end of the year? All of a sudden siding with the Villeroy and all in the council. I don't know, but. So, yeah, just if she's neutral, perhaps siding a little bit with the dovish, then I think stuff like euro sterling can really, and then I guess we are going to go for at least a very, very thorough test of that low 82.
Yeah, yeah. I mean, I'm still bearish the euro, but then I like a big fat level, especially when it hasn't been tested.
It is enormous, this level in euro sterling.
Yeah,
If
I
you
mean,
look back to 10, 15, 10, 12 years ago, there's a couple of really, really good lines there and levels.
Yeah, absolutely. So it's definitely a level worth considering, at least on the first test. And if I decide to flip to a long, it won't be because of the fundamentals. It will be purely because of the technicals on that big figure. And and if it breaks, then I'll probably flip short anyway. So I can still get back that way. Ali, you're asking about thoughts into 2025. We'll probably cover those a bit more next week, since it'll be our last flow show week next week. But yeah, I'll be staying bearish on the euro, bearish on euro sterling as well. But I will be keeping an eye on the on the UK economy side of things as well, in case things start tipping over here. Aussie dollar, I'm still bearish, but on the Aussie Kiwi, playing the divergence. I'll be keeping an eye on that one because it does feel like maybe that trade has run its course now that the market is siding with the dovish side as well. So I'm keeping on that trade. As for dollar yen, that will probably remain a wild card next year as well, as much as it's been a wild card this year. I'm a little bit long at the moment. Bought yesterday off the 152 for a test and managed to knock a bit out in the rallies up to near 60. But we've had a couple of tests of this one. We had one overnight as well. This 152, 150, 190s it got into and it held. So we've got a little bit of a range game going on here. 152.80s down into the figure. So really, direction's going to come whether we bust up there and go and have a look at 153 or whether we get back under 152. But otherwise, as I've been talking in the chat room, trading this one feels like trying to play football on a motorway. So, I'm aware of the traffic and the speed of the traffic around here. Kay, let's bang it over to you, mate. There you go.
I'm just looking at questions that came. Ali, you should join our chat room, mate. So many questions, and we are talking about all of that on the chat rooms very, very often. Right, Swiss. So we had this decision by the SMB cut 50. Look, we just tested the top end of that downsloping. Call it a wedge, some call it a channel, call it whatever you like. But we are testing those top sides, and it is still refusing to go. So that unfortunately is what is happening in Swissy. A lot of times we see the initial moves and then we are shying away. Obviously, we still have the ECB to come, but keep a close eye. If we start to get back above here, 93, call it 40, 50, 93, 40, 50 euro Swiss is really where we have to break to have a chance to start reversing potentially this whole weakness. If the ECB is not hawkish, I am afraid that perhaps we could be in again for this Swiss, which is behaving a bit strangely towards the year end. Dollar Swiss still 88. Figure a quarter, we jumped. We are still trading quite a bit higher now, around 88.65, but we need to break 89 to get going. Okay, not sure if the claims and PPI this afternoon will have the power to do so, but if we look at the dollar overall, it's doing pretty okay. Even the Aussie giving back what it's gained, Kiwi is giving back what it's gained, Euro dollar back below 105, cable a bit lower as well. So we are perhaps in for a bit of a test of this 89 if we get decent numbers out of the US this afternoon. Cable, and I've seen people are playing these both ends. As I said, I'm going to probably take this line out because it's far too steep for me. I don't really like it. So we are somewhere in a flattish market right now. Bit of a rangy stuff with 127.10 on the underside, 127.30, 35 where we are not too far off. In between, top end we still need to break above. I'd say 127. Call it 80, 90, confirmed through 128, the figure to get going. Haven't given up, but for the time being, I haven't done anything new either with my position. Still a bit long from nearly 2 weeks now. Trading it in and out and holding it for as long as we hold above these kind of levels here. And we will see what the rest of the day brings. The central banks do next week. We could be flatlining for a while here in the cable, perhaps. I was going to look at something. Oh yeah, I mean, I've given this one a little try. This is the longer term sterling Swiss. Okay. If we think that the sterling is going to remain a bit of a higher yield, or it may be possible that sterling Swiss is going to push through. But look what we've done. We've gone to test the top side of the latest range there that we have been building since September, and we failed again. So if we get back down below 85.90, where we are trading bang on right now, it's perhaps also one of those Swiss pairs where the hope is a bit false. So I gave it a try, but if it doesn't stay above this level here, I'll be quickly out. Quick look at what's happening on gold and silver. Gold, we are stabilizing, still above 27, but we are not breaking any new ground. This is a bit logical if you look at all what the dollars are doing. There's no real reason for anything to go higher versus the dollar rapidly, especially if you look at the yields in the US, which are holding up pretty well despite a very good 10-year auction yesterday. Yields are holding up in the US, so I reckon with a bit of corrective activity here on potentially on gold. So as the people know in our room, I've let a fair bit go. So now I'm in wait and see with a much smaller long position in gold. I still think it is the right way to be on the more medium term, but short term we need to reckon with a bit of a give back here potentially. I would say in gold. Let's call it 2690s or even 2675.80 or so. It would be possible, you know, before we reattack perhaps the top side. Silver doing exactly the same thing. It's moving around pretty okay level still here, but then there is a potential for silver, assuming that dollar yields are not rallying too far. I think there is perhaps a potential to go and have a look again at 32.85 before the month is over. But as I've said in the room with my long-term longs, if I see that level of up there, I'm for sure going to take part profits, because it could be that we are building some sort of a head and shoulder for which 32.85.90 would be the right hand side shoulder, and there we could potentially build a bit of a pause. And there's not much else I am really looking at right now, Ryan. Let me see in the comments. What else? No, I think we covered most of it all. Yeah, I'm giving it back to you, mate.
Thank you very much, mate. Yeah, good stuff as always. We'll call that a day for today. Take care. Come and join us on the Face Show a bit later. We'll see what the ECB have in store. Have a great day's trading, everybody. We'll see you all tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.